Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one actively managed member of our list of 72 favourite funds, namely Man GLG Undervalued Assets. This fund has a clear, well-defined investment approach with 3 dedicated team members who are entirely focused on uncovering out-of-favour opportunities. There's a bit of an ethos of exploring where others fear to tread and, given the contrarian nature of the process, also a willingness to invest in medium and smaller sized companies. As a result, the fund at times may look and feel very different from its benchmark, which is the FTSE All-Share Total Return Index. As we can see from this first graphic, just under 40% of the assets are held in large caps, a fifth in mid caps, and nearly 40% in small caps. The fund, which has around £835 million under management, seeks to provide capital growth over the long term, although it does also provide a yield of just under 2.5%. We're talking about the fund's accumulation units here, so those dividends will be automatically reinvested for you. Fund manager Henry Dixon and team currently hold 67 stocks and actually 2 bonds for good measure. The biggest positions in the fund, as I sit here, are house builder Bellway, Tesco, International Consolidated Airlines, which is the parent of British Airways, defence player Kinetic, and also Lloyds Bank. By sector, the biggest exposures are financials, miners and industrials. The fund has a 0 weighting toward utilities and healthcare, next to nothing in telecoms and also very little in technology. The fund is eligible for SIPs, ISAs and dealing accounts, and the minimum investment, well, that's just 1 share. The ongoing charge figure is 0.75%, so you do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 4-star ranking from Morningstar. So, those are the mechanics. The question to address next is why could investors consider this fund for inclusion in their portfolio today? And I think there may be 3 perfectly possible reasons. The first is that the FTSE 100 has actually underperformed on the global stage in total return sterling terms over the last 2 years. This will be an instant red rag to contrarian bulls, who will also be intrigued by the latest Bank of America Merrill Lynch Fund Manager Survey, which in November showed that 37% of respondents were underweight UK equities, the highest figure since the Great Financial Crisis. As a result, UK stocks, well, they feel a little bit unloved on a relative basis. The second reason may be that unloved often means undervalued, and the UK is not particularly expensive relative to its international peers or its own history on an earnings basis, with the FTSE 100 trading on around 14 times consensus analyst earnings estimates for 2018. The third possible reason is that if, and I stress if, momentum stocks fall from favourite and value stocks come back into fashion in 2018, just as they did in 2016, this fund could do well. Even then, the fund has a pretty good long-term track record of spotting value, as we can see here from the performance chart that dates back to the fund's launch in 2013. Now, none of this is to say that Man GLG Undervalued Assets Fund will suit every investor, also for 3 reasons. First, Brexit means that there is still some uncertainty hanging over the UK stock market and its economy, even as the negotiations enter their second phase. Second, there's growing perception of political risk in the UK as the minority May administration battles on and the Labour Party of Jeremy Corbyn makes what some have seen as some strident comments when it comes to utilities, nationalisation of assets and other areas of the market and the economy. Now, please note, this is not meant to be a political statement on behalf of myself or AJ Bell, just a reflection of how some sectors, defence, support services and utilities in particular, have performed poorly of late. Finally, the other issue to watch is that value-oriented funds require patience, as it can take a while, in fact sometimes a very long time, for a catalyst to appear that may unlock value at an underloved, potentially undervalued stock. 2017 was all about earnings and profit momentum, and 2018 could prove to be the same, with sectors like tech leading the way again, and remember, this fund's got very little exposure there. So investors must therefore do their research on Man GLG Undervalued Assets Fund to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.